You know Robinhood? For millions of people, it's the app that made investing feel, I don't know, as easy as ordering a pizza. But behind that super simple green interface, well, there's a multi-billion-dollar machine with a story that's, let's just say it's far from simple. So today, we're going to crack open their latest quarterly report, that's the 10Q filing, to really see what's powering this whole free trading thing.
Okay, so this is the promise you'll find right on page 1 of their official filings. Democratize finance for all. I mean, it's a powerful idea, right? It casts them as this hero for the everyday investor, taking on the old guard of Wall Street. And you know what? It totally worked. But, as we're about to see, this idea of democratization, it comes with a very, very specific business model.
So let's actually look under the hood here. Forget the mission statement for a second. What is the actual business? I mean, think about it. If you're not paying for the product, how on earth does a company offering free trades make its money? That is the billion-dollar question, and we're about to answer it.
All right, here's the game plan. First, we're going to uncover their real revenue engine. Then we'll look at their huge ambition to become this financial super app. After that, we're diving into the really serious risks they have to disclose in the fine print. And finally, we'll wrap it all up by asking, what does this all mean for the future of finance?
Okay, let's jump right in. Section 1, the real revenue engine. So again, if you're not paying commissions on most of your trades, where is the money coming from? Well, the answer is a pretty controversial industry practice that is, and this is key, at the very heart of Robinhood's entire model.
So this chart breaks it all down pretty clearly. See that big purple slice? That's 54%, and it's the key here. It's called transaction-based revenues. We're talking over half their income. Now, that blue slice, net interest, that's mostly money they make from customer cash balances and lending. But that purple transaction piece, that's the real engine. So, what exactly is it?
The answer has this kind of clunky name, Payment for Order Flow, or PFOF. Here's how it works. When you tap Buy on a stock in the Robinhood app, your order doesn't just zip straight to the New York Stock Exchange. Nope. Instead, it gets routed to these giant trading firms called market makers. And these firms actually pay Robinhood for the privilege of handling your trade, because they hope to make a tiny profit on the difference between the buy and sell price. That payment, that's the absolute core of their free trading model. And get this, that revenue is super concentrated. Just look at this chart. In the last quarter, one single firm, Citadel Securities, was responsible for 13% of Robinhood's entire revenue. Just one company. This heavy reliance on just a handful of market makers is exactly why this whole practice has drawn so much heat from regulators. And believe me, that's a huge risk we're going to circle back to.
Okay, so obviously relying so much on PFOF is pretty risky. So what's Robinhood's next move? Well, they're trying to diversify. They have this really big ambition. They want to become way more than just a trading app. They want to be your all-in-one financial super app. And they have absolutely been spending big to build this empire. I mean, just this year alone, you can see their strategy unfolding. They bought a company called Trade PMR to get into the professional financial advisor world. Then they snatched up Bitstamp, a global crypto exchange, to expand their footprint worldwide. And they're even moving into Canada with another deal for WonderFi. You can see how every single move takes them one step further away from just being a simple stock trading app. So yeah, the strategy here is crystal clear. Build a one-stop shop for everything finance. They want to be the only app you need for, well, everything. From buying your first bit of crypto to managing your long-term retirement account and maybe even being the platform your financial advisor uses. It's this vision of a complete financial ecosystem all in one place. But of course, with that kind of huge ambition comes huge risk. And this is where a document like the 10Q filing gets really interesting, because a company is legally required to lay out all of the potential risks. This is where we get the unvarnished truth about the major hurdles Robinhood is actually facing. And trust me, the list is long. First up, you've got regulatory risk. Their main moneymaker, PFOF, is under a government microscope. Then there's market risk. If people get bored and stop trading, their income just tanks. They're still dealing with the legal fallout from that whole meme stock saga in 2021 and are being investigated by pretty much every major financial regulator you can name. And, at a really basic level, their entire business depends on Apple and Google letting them stay in their app stores. And just to put a real price tag on all that legal pressure, Robinhood has already set aside $61 million just for potential losses from all these regulatory and legal battles. That's the real, tangible cost of playing in such a heavily scrutinized sandbox. Okay, let's switch gears to another massive area of both risk and opportunity: crypto.
As of the last quarter, Robinhood was holding almost $52 billion worth of crypto for its users. Let that sink in. That is a staggering amount of digital assets, and you can bet that protecting it is an absolutely massive challenge.
So how do they do it? How do you protect all that? Well, the report actually details their strategy. They keep a small amount in what are called hot wallets. Those are online, which makes for quick and easy trading. But the vast, overwhelming majority of it, that's held in cold wallets, which are completely offline and need actual physical access. Think of it like a digital vault, which makes them way, way harder to hack.
But even with all that offline storage, the risks in crypto are still immense. I mean, you've got the constant threat of hacks, you've got the insane price volatility which directly hits their revenue, there are weird technical risks like forks where a blockchain can literally split in two, creating all sorts of chaos and customer disputes, and hanging over this entire space is the huge regulatory question. Are governments eventually going to classify these things as securities? Because if they do, that changes the entire game.
All right, so we've dug through the revenue, the big ambitions, and all the risks. What's the big picture here? What does this all really mean when we talk about the future of finance?
Well, for one thing, despite all those challenges we just talked about, the growth is just undeniable. Take a look at this table. The total assets on their platform more than doubled in a single year. That's a 119% jump. And crypto assets, they grew even faster. It's proof that their core mission is really resonating, and millions of people are trusting them with hundreds of billions of their dollars.
And really, that brings us right to the heart of the Robinhood story. It's this fundamental tension, this constant push and pull. On one hand, you have that simple, really powerful mission to open up finance for everybody. But on the other hand, you have the incredibly complex, super high-stakes machinery of the global financial system that they have to navigate perfectly just to survive.
Which kind of leaves us with one last big question. As Robinhood keeps building its super app and grows into a true financial giant, is it just solving one problem, only to create a brand new one? Is the real price of democratizing finance actually a new kind of hidden complexity? Things like payment for order flow, for the very same everyday investors it promised to empower in the first place?